Hello everyone. We're going to make a quote over here for one client. We're gonna put this is a Secure Life Plus product, universal, guaranteed universal life policy. And we're gonna go ahead and do the the illustration. We're gonna do the illustration three different ways. We're gonna do just to illustrate one level of coverage with three or four different uh, premium amounts. So let's say that this customer is born in May 5th, May 5th of 1978. May 5th of 1978. Female, non-smoker. This time we're gonna pick the state of Florida, and we're gonna try to. The lady really wants, in this case, she asked a couple of questions. One of the questions was, can she do a can she do 250,000? So the customer in this case is really asking for $250,000 worth of coverage. And as I have mentioned before, the ratios that we use for the uh, universal life policies is pretty simple. In this case, in this particular case with Occidental, you could actually do a 3-to-1 ratio, which basically means you have a term three times higher than the face. So this is the term and this is the UL coverage. Or you could do a 2-to-1 ratio or a 1-to-1 ratio. In this case, we're going to do a 3-to-1 ratio, right? Which basically means we're going to do 3 times term insurance, 1 time UL. This will make the policy at 250,000 or whatever this number would be. This is what's going to make it the least expensive way. So if you divide 250,000, even if you divide that by 4, it's going to give you $62,500. This it's going to give you the one time right here, the one time right here. Okay, so that means that if you multiply that times 3, that's going to give you 187,500. And now we're going to illustrate this over here, obviously because the customer is still young and has over 20 years to cover the policy. So here's what's interesting. We're going to put $500,000 right here on a monthly draft, and we're going to come down over here towards the term rider, and I'm going to put 187,500 for 20 years on the primary covered person, right? I'm gonna do waiver of a monthly deduction right here, just because it is so inexpensive that a lot of times it's easier just to tell the customer it is included with that benefit, with that policy, just because again, at that age of the customer, if she's born on 1978, the waiver is going to be so inexpensive per year that it is just the best thing for the customer. Now we're going to come out and say, okay, we're going to get the premium, and as we can see, we're going to do a target premium of 83.54. So that's already a good price. And if we illustrate the minimum, it's going to be $60. So $60.06 will take the customer up to 20 years guaranteed. Obviously, with the minimum, there's going to be no accumulation. It's basically 20-year protection for $250,000. If we take target, it's going to carry a little farther. And if we do the maximum, this is the maximum the customer can send into her policy, $167.60. This will indicate that is the maximum that the customer can send, but it's going to illustrate the maximum accumulation at that level. The customer could potentially send more money if the face amount for the UL is higher. So if the face amount for the UL is higher, the customer can potentially send more money into the policy. So then you get into a different ratio, which would be maybe a 2-to-1 ratio or a 1-to-1 ratio. The UL coverage amount indicates what the maximum would be in the policy. So now we're going to run the illustration. We're going to start with minimum. I'm going to click get premium. Then I'm going to go to the bottom. I'm going to hit continue. I'm just going to put it in a folder, and I'm going to illustrate. I'm going to save it under the customer's name. I'm just going to put, in this case, it would be Christy. Minimum 250K, just so that we are good with recognizing the file. Now I'm going to come up. I'm going to click target. I'm going to click premium. I'm going to come down, hit continue. And I'm going to do the same thing. I'm going to save this into Christy. Target 250,000. So I'm going to do that. Now I'm going to go ahead and go to maximum. I'm going to get premium. Click on get premium. Now we're going to illustrate. We're going to click continue. I'm going to illustrate Christy max. This is the max. Sorry, max 250,000. We're going to save that. Now we have obviously three different files. The minimum, target, and the maximum. If we already know the minimum is $60 and the maximum is $167.60, well, it makes sense that the customer can pay from the minimum to the maximum. The customer can pay whatever the customer chooses that he can pay. In this example, we can tell the customer, okay, you got $60 minimum, and we explain that part of the policy for that same coverage. The maximum will get you the maximum accumulation of cash, $167.60. Anytime the customer can change this monthly premium. That is why we call it a flexible premium policy. But the customer can specify between the minimum and the maximum, whatever the customer chooses. Example, I can put specify right here and go to $80, and then I click get premium. So I specify now at an $80 premium. So I did that, and we can run that illustration, and we're going to save that illustration under, in this case, Christie specified 250K, $80. So now we can look at the policies. We can see the minimum. right here, and you want to really look at the cash accumulation after 20, 30 years, really in this case. So you can see on the minimum, it's only going to carry for about 20 years, and then it's going to go to zero. And there's really going to be a no cash surrender the first 10 years. So I mean the first 9 years there's no cash surrender. So if they surrender the policy, there's no surrender charge, but there's really no accumulation. Now let's look at target. If you look at the target, and if we go look into 20 years, now the customer's got $7,900 of policy value and cash surrender value. Yes, so there's the illustration on the accumulation. If we look at the maximum, at the maximum amount that the person can send, then if we go to the cash accumulation, you can see same level now that she's got 33,000 right here, right around 20 years, probably a little higher than that. But you can see that this is built for cash accumulation. And if you really multiply, for example, 10 years times $2,000 outlay, there's going to be about $20,000 outlay in 10 years, but the policy value is right at 16,000. So that really means that for 10 years she only paid basically $400 a year for her policy. If you look into later years, like 29 years, this is almost 60,000. So if you think at the return of premium policies, which run right around 30 years, so on this maximum, they're gonna get the return of premium, but the only the the biggest benefit for this policy is that the policy will not term. Basically, it keeps going with the high death benefit, and you can see the death benefit. If they want to deposit more into the policy, then the UL premium has to be higher. And then obviously lastly we're gonna look at the $80, that's specified premium. We're gonna go to the third page, and with an $80 monthly premium, you're gonna see your accumulation. So the important thing is to catch the policy with a maximized amount in the early years rather than the later years. So, but you gotta be aware that the customer can change the premium anytime, flexible, and if they want the ability to deposit more into the policy, the UL premium needs to change. The UL premium, the higher the coverage amount on UL, the higher the maximum will go. Thank you. That is what I got today for the Secure Life Plus product with Occidental Life.